Experience here in Silicon Valley. We are here to talk about the real estate market and what's happened in the last week and what it reflects on what's happened with the new year. A couple key URLs. Basically, I have a base URL that showed in the green here. You add 2021 to get today's live presentation, add the word handout and the 8-digit year, month, day to the end of it, and you'll get the handouts for today's slides. That's the root URL. And then if you add in the date code without the word handout, you get to the archive on YouTube. With that, we'll get into the presentation. So this is the first graph. DUI is days of unsold inventory. It's basically a measure between the supply, the current inventory, and the demand, the number of offers that are coming in. In a free economy, the supply-demand ratio is what determines what happens with prices. We have two lines. We have the gold line, which is the 5-year median. The 5 years selected were 2015 through 2019. Those happen to be 5 great years. So if we're doing similar to those years, we're having a great year. The blue line is the current data. A low DUI is a faster marketplace. In other words, if your DUI was 40, that would say it took 40 days to sell your existing inventory. If your DUI was up here at 80, it would take 80 days, twice as long, half the speed. Between those two numbers is what I consider a balanced marketplace. Where are we? We're down here at something like 20 days of unsold inventory. That is just insanely fast. It's faster than the median has been on the 5 years, which is probably about 24, which is still fast. You go anywhere else in the country and you say, we'd sell every one of our properties in 3 weeks, they would look at you like you came in from Mars. Here are the actual numbers broken down. So if you're looking at the macro for San Mateo County, Santa Clara County, single family homes, condos, and townhouses all combined, based on the last week, we only had 22.1 days of unsold inventory. Based on the last 4 weeks, we had 23.8 days. Then if you break it down by single family, you're at 20 and 21 days. Condos are slower at 25 and 27 days. But now let's look at the difference between the counties. San Mateo County is sitting here at 29, almost 30 days of unsold inventory. Meanwhile, Santa Clara County is either at 17 days for the last week, 18.9 days for the last 4 weeks. This is incredible. I mean, for 17 days, you would sell every one of your properties on the market if it was evenly distributed. Now, obviously, it's not. There are some properties that aren't going to sell at the price the seller's demanding, and they stay on the market and the inventory increases. An inventory, because it's available, but it's not going to sell because it might be 50% above the market value, and there are properties out there like that. So you can see there's a huge difference between the two counties, and then even if you look at Santa Clara County, single-family homes at 17 to condo townhouses at 25, that's a pretty significant difference. If you look at San Mateo County, 27.7 to 29, there's really no difference, even 34 to 30. I mean, that is no significant difference. 17 to 25, you would notice that. So the hottest marketplace remains single-family homes in Santa Clara County. Right now in the entire county, there's only 611 homes available. We got 252 offers last week and 904 over the last 4 weeks. And if you just take the 250 and multiply it by 4, you're basically at 1,008. So that's faster than the 904. Why is that? You're getting further away from the holidays. More buyers are out. There's more inventory for buyers to buy, and it leads to more sales. Now what we're doing is looking at the supply demand, each component, and the supply has two components. So the first component is how many new listings are coming onto the marketplace, like how much water is coming into your reservoir to fill up the level of your reservoir. And that's the gray line here. And you can see we're coming down pretty close to normal. You're still somewhere around 107% of normal. Normal would be right here on the gold line, but we're not up here at 140%. Where's the available inventory? The available inventory is coming down right along with it. It's somewhere around 122%, 124%. So what does that tell me? It's saying that we've had an influx of sellers earlier this year for some reason. That seems to be drying up. That is not what I was expecting. I was actually expecting, and maybe it will happen coming forward. But because of Prop 19 passing, I and almost everybody else was expecting some of the folks that have been in their house over 55 and won't move because of Prop 13, now they can move and take their property tax with them. So that disincentive has gone by. You would expect more properties to come on the market, especially with the high price of homes in the Bay Area, with a 250 exclusion per person on capital gains. That becomes significant because if you're at your 250 or $500,000 cap, you're only seeing about 60 cents on the dollar of future appreciation. Where if you sold your house, moved next door, had the identical houses, went up in the same value, you're now getting 100% of that future appreciation. So all of a sudden, it's going to become financially beneficial for sellers, the average consumer, to be trading with their identical next door neighbor's house every time they hit their cap, whether it be 250 or $500,000. Now you do have to look at the cost of buying and selling and the hassle of selling. So, you have to weigh out that if you're going to be moving in a year or two, you stay put. But if it's still a long-term home for you, move, because that extra 40% appreciation every year on the total value of the house is rapidly going to more than cover your financial cost of moving. So anyway, new inventory and total existing inventory are still both above where you'd expect it to be for this time of the year. Where are sales? Sales are still way up here. They're over 140%. And the reason for that is sales are based on inventory that came on the market last week. In other words, this week, homes that came on the market, they'll be shown this weekend and the offers will be accepted next week. So there's basically a 1 week lag time. So basically, because there's very little inventory and there hasn't been new inventory, I would expect the number of new offers to come down next week, not because the demand isn't out there, but because the supply is not there. What will also happen is some of the properties that have been overlooked for recently will now get offers on them. So the other thing is the number of new offers, and that's what we were just talking about. I do not expect this huge decrease down here. So what would I expect? I still expect it to float around where we were, 125%, 130% of the normal market. Right now, I would say it's going to be going down to 100% and just be a normal, fantastic year. There is no way to know. I still think Prop 19 is going to come in and pull up more inventory. Here, we're just looking at the total inventory, and you can see that inventory actually decreased from last week to this week. It's not a huge decrease, but you can see historically, you're on a rapid increase in the available inventory at this time of the year. So even though this is just a small little decrease, it is significant, and it just means there isn't the sellers to sell. If there isn't sellers, the buyers will bid up the price. Again, I do not expect this decrease to happen because of shelter in place. And just in case it's not obvious, when this purple line, which is the division line between 2021 and 2020, reaches our COVID line, that is our 1 year anniversary. So we're basically 2 weeks away from our 1 year anniversary of shelter in place. Here is looking at just the number of new listings. You can see the number of new listings is now much closer vertically to the 5-year median. And you can see the 5-year median does have some dips. These are associated with holidays. Holidays are having less impact with COVID since people aren't supposed to be traveling, which is why we're more on a straight line. We did have some fluctuation here, and I'd have to go back and look at my calendars. This is Martin Luther King's dip down, and this was President's Day dip down here, which really didn't happen. So the number of new offers accepted, we had a spike in new listings last week, so we had this spike of new offers this week. I expect this to come down, not because it came down last year, which was COVID related, but I expect it to come down just because there isn't the inventory for buyers to buy. Closings, same as the number of offers. When I get my final presentation, this slide may be going away. I'll leave it for a while. It's basically lagging behind, and you really don't get any information over it. It's more almost confusing. But you can see we're up, and I expect this to go up, and I don't expect the dip to come down here because this was the COVID. This was when we couldn't sell any real estate at all, or couldn't show any real estate. First, we couldn't show any real estate. Then we could only show vacant properties. This is the number of new expired listings, or actually expired listings. This slide will be going away. I don't see any value. We are talking basically down here somewhere around 10 listings out of some number around 2,500. It's just a drop in the bucket, and it's just a slide. Okay, this spike here on expired listings is because of listings that have been on the market for close to a year and now are expiring because they didn't sell. Now going forward, I don't expect to have any future spikes in expired listings because very few people take a listing for more than 1 year at a time. So if there aren't any listings that were taken before shelter in place, I would expect the number of new expireds to pretty much follow the gold line. The spike happens at the end of every month because people tend to expire listings at the end of the month, which is just interesting behavior. This is canceled listings. This is new cancellations, and it is sort of surprising to see cancellations up. And the only thing I can think of is that sellers putting their house on the market with unrealistic expectations of the inconvenience of showing during COVID, and then deciding it's not worth the hassle. Most of the properties that I have been showing are vacant, and I think that is going to be a growing trend during the duration of COVID. This is the number of withdrawn listings. This again will be going away. You can see withdrawn listings was higher after COVID. Now it's a pretty low number. Even if you call it 15, which is being very generous, 15 out of 2,500 is just a drop in the bucket. This slide now becomes meaningful again, which is why I want to get rid of some of the stuff that's meaningless. This tells you the frequency of overbidding, and look at the jump up. So even though we had more inventory come on the marketplace, we had more offers come on the marketplace, the buyers felt they had to overbid more often, and we're right at almost 70%. I think it was 68.7% or something like that. So we're just still slightly below 70. The all-time high that I remember is basically 80, which was when we were in the insane marketplace. I don't expect to see that again. I keep forgetting it, so I'll do it at the end of the slide. This red red shading should come all the way down to 50. The blue shading is correct. Here is magnitude overbidding. The shading is correct on this slide. Magnitude is how much are buyers overbidding, and look at the increase since the first of the year, and we're now at about 105.3%. So that's getting up there. We have been at 112% in the past. I think we're basically with the vaccines coming out, getting a year away from shelter in place. I think the consumers are getting used to it. So the insult of shelter in place is no longer holding the buyers back, and they're willing to overbid. So I expect this magnitude to go up quite a bit this year. Now we're looking at the price distribution. This is macro data. This is Santa Clara County, San Mateo County, single family homes, condos, and townhouses all together. And what you do is each line is the closings that happen in a given week. The most recent line is the red line. And notice it's basically the highest one going diagonally up and to the right. That means that's the best marketplace. Well, yeah, there is the one over here, but this is the best month we have ever had, which was April of 2018. This is the worst month we ever had, which was December of 2001. So in the recent last 20 weeks, the current past weeks, the best week we've had. The concept here is the solid lines are the most recent, the dashed lines are the next oldest, and the dotted lines, which are pretty much buried, you can see one right underneath my laser pointer in the center of the screen. That is the oldest data. And so basically we're improving. I would expect this to continue to go up in this direction, at least for the next several weeks. This is the same data, not as much of it, so you can see it a little bit better. So this week is the red, last week was the orange, the week before was the gray, and the week before that was the yellow. So you can see there was a huge discrepancy downward or increasing because we're going forward in time. And then the dashed lines were a little more jumping around, and the dotted lines are down here. Now remember, these dotted lines are more recent than the dotted lines on the previous slides, because these dotted lines, as you can see, are basically December, where in the previous slides, the dotted lines were way back in October. So I deleted the oldest data and kept the same nomenclature with the formatting of the lines. Now, this slide, you got to be a little bit careful. We're looking at February, and you'll notice it says February the 7th, March the 7th. We're clearly not there. So this is not the entire month's data, but this is sort of to give you a snapshot of what the data would be right now if it was the end of the month. And the reason I'm doing this is to compare what's happening in the marketplace now to the last 20 years. And so what are some of the benchmarks? Well, let's come down and let's go in the highlights. We only have 598 homes on the marketplace, call it 600. If you look at that, that's the lowest inventory we ever had for this time of the year. Now, if you go to 2018, it's 615. 615 isn't that much higher, but that 615 is from March the 7th. So I expect this year to have a little bit more inventory than last year, but when the real numbers come in, this will probably be the second lowest inventory year we've ever had. Go down to average days on the marketplace. You're at 17 and 8. You were at 8 and 20 last year. In 2018, you were at 15 and 8. But other than that, Well, I guess 17, you could say 20 and 9 is pretty close. Other than that, these are basically tied maybe for first place, and everybody else is a distant second. So we're having one of the hottest marketplaces. Now come down to DUI, and don't know which direction DUI would go. Sorry, increased inventory would tend to make DUI go up. Buyers coming on the marketplace would tend to make it go down. I expect it to sort of be stable, but if you compare the current 17 to any of these other past months, this is a record, and it should be fairly accurate of even what I'd expected to be at March 7th. What I'm basically saying is the speed of the marketplace for single family homes in Santa Clara County is the fastest we've ever had in the last 20 years. And I can represent to you, it's faster than what we had back in 2002, 1, 20, 99, and 98, because that's how long I have data for. So that is pretty insane to be in a questionable economic time with shelter in place and be having the fastest marketplace. Let's look at the number of offers. I guess I don't have that. Let's jump down to days on market for closings. This isn't nearly as significant as the offers accepted because this is delayed. And so this is really data from January. So we'll skip over that and just go right down to the sale price. So the magnitude of overbidding at 105%, it looks like to me it's in an honest second place. We're pretty tied for here in 2015, and I'm not seeing anything else. So the only year that beats us is 2018. And the reason 2018 is beating us is from the insult from shelter in place that I was talking about. And if that insult completely goes away, I would expect us to be right up here in this 112% range. You right now have 69% of the sellers getting more than their asking price. Clearly in 18, it was better at 84%, which is unbelievable. But if you keep going back in time, again, this is the second best year. So what am I saying? I'm saying this is probably the best year we've ever had, even though some of the data points indicate it's the second best. It's pretty close tie. If someone wanted to say it's clearly second place, I'm not going to argue. It's right there. It's first, second place, and that's just unbelievable. Sale price, this becomes interesting. This is comparing the median price of not the median price, the lowest 10 percentile at 875. It's up dramatically from 810 from last year. The median is almost unchanged. And I will throw out a word of caution, the fact that at 1378, that's probably a real number. Asking price, there's probably a whole bunch of listings right around 1398, 1395, 1399. So once we get above 1400, this is going to go jumping up quite a bit. So there's just a whole lot of listings you have to break through to get above that. So I believe the median appreciation is greater than the numbers show because you're bubbling up towards the top of it. It's just a statistical nuance, and the high-end homes are up. Basically, the argument is if the low end is up 10%, the high end's up 10% roughly, I'd expect the middle to be up 10%, even though the numbers don't show it. And that concludes my summary. So with that, I will open it up to questions for this week. And I will throw out the reminder that 2 weeks ago was the presentation of the monthly data. So you can look at the archive on that if you want to do it. And with that, any questions?
Nope.
All right. Thanks for joining me. I'll see you next week.